I'm going to teach you the most valuable thing you can learn in business. The financial statements are something everyone should understand. And by the end of this video, you should be able to understand not only how to read them, but also how they're connected. To get started, download this infographic and this Excel file to follow along. Let's begin. Okay, so let's start with a refresher on what are the financial statements. Most commonly, when people say these words, they mean the profit and loss, the balance sheet, and the statement of cash flows. Now, you may also hear of the statement of changes in equity in the notes to the financial statements, but usually people aren't really referring to that when they say financial statements. Now, I have videos on all three of these topics, which I'll link below, so I won't go into detail on what each of these are and what? They want me to do a refresher? All right, let's do it. First, keep in mind that financial statements can be prepared under the accrual basis or the cash basis. Now, I'll also link to a video on that below, but we're gonna assume that we're gonna use the accrual basis for today's discussion. So let's start with what exactly is a profit and loss. This tells you about the profits or losses that your business is generating. It's separated by revenue, cost of goods sold, operating expenses, other income, and other expenses. So it summarizes all of the income that you're generating and all of the expenses that you're incurring. And then you can analyze profitability at multiple levels. Put differently, the profit and loss tells you about the performance of your business. Next, we have a balance sheet. And as we'll see shortly, this is the most important financial statement of the three. This shows you a snapshot of what the business owns, which we call assets, then what it owes, whether that be to creditors, which we call liabilities, or owners, which we call owner's equity. Put differently, the balance sheet shows you the position of your company. And unlike the profit and loss, it's a snapshot in time where all of the values shown are cumulative. Now, our last financial statement is the statement of cash flows. This statement is designed to tell you about one thing, your cash. That's gonna be annoying to clean up. Put differently, it explains where your cash is going each period, and it's summarized by cash from operating activities, cash from investing activities, and cash from financing activities. Now, you can prepare a statement of cash flows using either the direct or indirect method, but we're gonna use the indirect method today. Now that we're up to speed on the three financial statements, let's talk about how exactly they're connected. At a high level, the profit and loss doesn't pull any information from the balance sheet or statement of cash flows. Instead, it pushes information to both statements. The balance sheet, on the other hand, well, it pulls information from the profit and loss and it pushes information to the statement of cash flows. Then the statement of cash flows, it just pulls information from both statements. So put differently, the profit and loss is the most selfish statement. It just gives the information to the other two statements. The statement of cash flows is the most selfish statement. It just takes and takes. The balance sheet is the one that balances it all. Is that why they call it a balance sheet? Okay, let's review this in detail. So like I said, the profit and loss pushes information to both statements. That's all via an account called net income. Net income is pretty much your bottom line profitability in your business. You take all of your income accounts, you subtract out all of your expense accounts, and you get net income. It pushes this information to the balance sheet into the equity section. Now think about this for a second. Every business has at least one owner. That owner gets a share in the profits and losses. So until the owners pull out their money, this gets accumulated into an account called retained earnings. Technically, this can be split by an account called net income on the balance sheet, which accumulates each month in the year and resets its balance on the first of each year by transferring the balance to retained earnings. Now, the statement of cash flows also pulls in this net income line item and is a starting point for how the statement gets prepared under the indirect method. We put this under cash from operating activities because, well, your profit and loss summarizes your net earnings from operating your business. Here, let me show you an example. Let's say I'm running a consulting firm. It's day one on the business and we have no money in our bank account. And we haven't had any business activity yet. If I do work for a client for $10,000, that means that my revenue goes up by $10,000. Notice what happens to my net income when I enter $10,000. If I have no expenses, then my bottom line net income goes to $10,000. But also notice what happens on my balance sheet. My retained earnings balance goes up to $10,000. If I post $5,000 in earnings next month, my retained earnings balance goes from $10,000 to $15,000. Remember, the balances shown here are cumulative. but the balances here are incremental. Look at what's also happening on my statement of cash flows. If I don't have any activity on my balance sheet, that means that I received $10,000 in cash and then $5,000 in cash in the following month. And as you can see, this net income line pushes to my cash from operating activities, which also gets represented on my balance sheet as $10,000 in cash and then $15,000. The amount grows by $5,000. Now, aside from net income, the profit and loss also pushes depreciation and amortization expense to both statements. For the balance sheet, these line items get accumulated into accounts that we call, well, accumulated depreciation and accumulated amortization. Really? You guys couldn't think of a better name for this? Okay, so now we know how the income statement connects to the balance sheet and statement of cash flows. How does the balance sheet connect to the statement of cash flows? Okay, I'm gonna let you in on a little secret. Come here. See, the statement of cash flows, it's really just showing the net change in all of your balance sheet accounts except for cash. That's all it is. Since assets equals liabilities plus owner's equity, that means that the net change in assets must equal the net change in owner's equity and liabilities. So if you just remove cash, there's your plug. That's what a statement of cash flows is. Let's go over a textbook example of how exactly this all works. Recall that the statement of cash flows is separated by these three sections. Operating activities involves activities related to operating the business, which is why we start with net income and add depreciation and amortization, which is the wear and tear of our fixed and intangible assets. We'll also include the net change from our current assets and current liabilities from our balance sheet. These are assets that are expected to be converted to cash within 12 months and liabilities that are expected to be paid within 12 months. So going back to our example, let's say in month one, when I generated $10,000 in income, the client only paid me 50%. Well, that means that my accounts receivable balance goes from $0 to $5,000 in this period. So although I have $10,000 in income on my profit and loss, the statement of cash flows will offset my cash balance by $5,000 over here. Since I have an increase in my assets, meaning instead of receiving cash, I received an IOU. The same is actually true for current liabilities. Let's say I paid $1,000 on office rent. That means that my net income now is only $9,000. But if I haven't paid this yet, that means that my accounts receivable balance will go up by $1,000. An expense for $1,000 means that my cash goes down by $1,000 in the form of a lower net income, but an increase in my liabilities by $1,000 means that my cash goes up by $1,000. Instead of me actually paying the amount, it's now an IOU. Okay, just like the statement of cash flows pulls from the balance sheet from operating activities, it does the same for investing activities. Cash from investing activities means cash related to fixed assets or long-term assets invested in by the business. It does not represent cash invested into the business. That's in our next section, financing activities. So what exactly is a fixed asset? How about machinery or real estate or office furniture or long-term bonds? The idea is that I took out cash and swapped it for one of these assets that I'll be benefiting from in the long term. So over here, when I add $10,000 for machinery, my cash flow statement shows the $10,000 outlay in the investing activities over here. Now we have one more section, and that's our financing activities. This represents cash movements from all activities related to funding or repaying any debt or equity from the business. So for example, let's say we took out a $50,000 loan, or let's say we got a $100,000 investment from a new owner, or let's say we repaid a $5,000 amount from our loan. All of these activities will go to the financing section of our statement of cash flows. So check out this example. Our debt balance on our balance sheet grows from $0 to $50,000. This then gets pushed to our statement of cash flows where we see the $50,000 increase. As a recap, the profit and loss pushes net income each period to the balance sheet into retained earnings and into the cash flow statement via cash from operating activities. It also pushes depreciation and amortization into both the balance sheet and statement of cash flows. The balance sheet pulls in net income from the profit and loss and pushes the net change in every account other than retained earnings, accumulated depreciation, and accumulated amortization, since that pulls from the profit and loss, and that all goes into the statement of cash flows. But the change in current assets and current liabilities goes into the operating activity section of the statement of cash flows, while the change in long-term assets goes into the investing activities from the statement of cash flows. And then the change in any capital put in or repaid to debtors or owners of the business goes into cash from financing activities. Whew! All right, did you catch all that? I'll get to my career when it all clicked, and I hope it is the same for you. Once you understand this concept, you'll start to see this connection everywhere, whether you're playing the piano of financial statements or taking a look at the universe of financials. Let me know what questions that I can help with in the comments below, and I'll see you in the next video.